اسمع واحد قبيله الشيف ديالو. Line up ready? You can go.
Ladies and gentlemen, welcome back to the conference room for our 8th session about Europe, competitiveness, macroeconomic challenges, and global competition. Please welcome to the stage the moderator for this session, Deborah Rivoltella, Chief Economist at the European Investment Bank. And the speakers for this session, Boris Vojcic, Governor of the Central Bank of Croatia. Bojan Vasley, Governor of the Central Bank of Slovenia. And Paolo Gentiloni, Commissioner of Economic Affairs at the European Commission. Deborah Rivoltella, the floor is yours.
Thank you very much, and it's a real pleasure to have the opportunity to moderate this panel, which is the European panel in the conference. So it's particularly interesting to have a reflection on the challenge for Europe here in Marrakesh during the meetings. And I have a fantastic panel with me. They have already been introduced, but I think it's really the good people to talk about the topic. And what we are talking today is about competitiveness, European competitiveness, and the challenge ahead. I think the background story, I think, is something that we are all discussing since a long time. We know that we are coming with an history of low potential growth in Europe, need of transformation related to the digital and green transition. And those also bring the issue of reallocating resources from some sectors to other sectors in the process of the transformation. But we also saw that we come from years of shocks, the pandemic first, the energy shock, and a lot of successful policy intervention, and I think we will discuss part of it. But the successful policy intervention kept the economies growing in the last year, kept focus on transformation, and I think the Recovery and Resilience Facility had a very strong role in keeping the transformation of the economy going, but also avoided a major financial shock so far. And what we see is an economy that today is in a better shape of what could have been given the shock that we have seen. But also we know that there are headwinds coming, and that's the challenge is really what to do with the risk coming up. On the monetary policy side, I think central banks have been very vocal in terms of the fight against inflation and what does it mean. We have seen also in the previous panel the discussion on the tightening that is coming, but it's less felt than it could be given the phase of the cycle. And all of this leaves with the big question mark of what's next. On the one side, the structural need of transformation. On the other side, the limited policy room going forward, the accent being all on the supply side of the economy now, and with very limited fiscal capacity coming up, given the level of public debt that we see. So that's a challenging environment. I have the pleasure of a great panelist, and I will start with Commissioner Gentiloni. with a discussion on where you see the economy going, and how much do you think that the last years, with all the complexity, really led to some structural transformation of the economy, and what are the structural challenges ahead?
Well, thank you very much for this meeting, for this invitation. Indeed, you know that the euro economy is weak at the moment. We have seen the IMF outlook a few days ago, which was, I think, 0.7% this year and 1.2 next year. The Commission forecast that I presented 1 month ago were slightly better for next year and more or less same, maybe 0.8 for this year. This means weak growth, of course. I think when we look these figures, we should consider at least two things. First, 1 year ago, if we would have met, we expected a much worse economic scenario. We were expecting recession. We were expecting big problems of energy supply and even blackouts in our economies or in most of our countries. This didn't materialize. We had, I think, an enormous capacity of adaptation of the consequences of the Russian war in Ukraine, especially on energy. In a few months, one of the pillars of the economic model in the last quarter of a century, which was cheap pipeline gas, was brought from 40% to 8-9% in our energy mix. And for some countries, this was incredibly important. So we went through a second shock after the pandemic, which is not comparable in its economic consequences with other areas of the world. I'm not saying that the Russian war in Ukraine didn't have economic consequences in other areas. Of course it did. But for Europe, this was not only a geopolitical with trade consequences issue, it was an issue affecting pillars of our model. So now, at the same time, we have to address a new global race for clean technology and competitiveness, started in the last period, which is for Europe an historical challenge mixed with geopolitical instability that we are experiencing, of course, also here in the region, and we know very well. So what is, do we have a plan? Do we have a way to address these challenges? I think I like a definition that I heard from a French pro-European personality, Pascal Lamy, when he said, Europe can't be the only herbivore in a world of carnivores. Meaning that when we refer, and this is the label that we use, to the European strategic autonomy, we are referring to a substantial challenge for the EU model, which is the challenge of keeping some of the fundamental pillars of our economic models without losing the global race and using our assets for the global race. This means, in conclusion, our assets. This means, in my view, first, leverage on our strength, meaning especially the strength of our single market, the richest market in the world, and even strengthening this single market. Second, this means using the tools that we have. Deborah was referring before to the recovery plans, Next Generation EU, the RRF national plans. These plans, of course, are unprecedented in their tool, which is, as you know, common funding from the European Commission in financial markets for 800 billion, which is a big, unprecedented thing. Make this plan work is a challenge in itself. I think this plan already, and you already mentioned this, had an impact when the Next Generation EU was presented. Because the very fact that it was conceived and presented stabilized financial markets and avoided fragmentation. So if you look to the picture of EU growth in these months, you don't have a picture which is automatically reflecting fiscal capacity of different member states. And this is also partially, at least, an effect of the rebalancing through Next Generation EU. And within this, of course, we need prudent fiscal policies, not to undermine monetary policy, and we need an agreement on fiscal rules. So, big things we need. Third and last, to adapt the European model to this global race to clean technology, to this global race to competitiveness, to the new shape of globalization, I think we will need, this is not for tomorrow, but it is maybe for the period after Next Generation EU expiring, which will be in 2026, we will need again to address the issue of common tools for common goals, common goods, common purposes. Because, of course, this race for competitiveness will be mostly based on private investment. This is obvious. And we have to work on capital markets, on taxonomies to make this stronger in Europe. But we can't ignore the simple fact that in this global race, there is also a big role for public support. This is happening through IRA. This is happening in China. This is happening in Europe through Next Generation EU. We have 270 billion for the green transition and 160 billion for the digital transition in these plans. But what next? What further common tools for common purposes after 2026 will be one of the big team for the coming Commission and the next mandate of the European authorities. Thank you.
Thank you very much, and I think you put a number of very important points that we will come back later on. What are the tools for financing the public goods at the European level? But I would switch, I don't know, Bossen, you wanted to start? Your view, inflation, or also what to do with the supply side of the economy. I know it's not you as a central banker, but your views. Thank you.
Deborah, thank you, and thank you very much to the organizers for inviting me here, and also for the authorities for organizing this excellent events, official one, the IMF World Bank meeting, and all the side events, and giving us opportunity to hopefully have very productive debates. So in picking up the words to describe current situation, my choice is complex. The situation we are facing is very complex. Now, first of all, looking backward, what is behind us is, first of all, the Corona crisis, something which happens once in 100 years. Then there was Russia aggression on Ukraine, again, something which happened for the first time since the beginning of the Second World War on the European soil. So it was a big disturbance to our economies, to our policies. And not only economic and geopolitical situation, environment is very complex. Also the response of policies was very much different to what we witnessed before during the past crisis, and again, very complex for us policymakers on the side of fiscal policy, and of course on the side of monetary policy. And what we are living through at the moment are still the consequences of these past two crises and past policy decision. And of course, as you mentioned, and yeah, not only in front of my eyes, our eyes as a central bankers, but I think in front of eyes of policy makers in general, is inflation as the major macroeconomic issue at the moment. So what we are seeing as a response is a bold reaction of the central banks around the world, including ours, ECB, strong campaign of interest rate increases, 450 basis points altogether, from minus 0.5 at approximately this time last year to 4% at the moment, and also accompanying process of quantitative tightening, which already started and is progressing quite well. On the other side, this response of the policies trajectory we are seeing in the real part of the economy is affecting financial markets, banking sector in general very much. What we can witness here at the moment is a situation which can be described as satisfactory at the moment, and it is again a consequence or result of policy action, monetary again, fiscal again, and better framework which was built after the last big financial crisis, and is from the today perspective much different, and I can assure you much better as it was 15 or even 20 years ago. But you also asked for our view for the future, what the prospects are. Of course, what we are providing, I believe, are good foundations to restore the price stability, to preserve financial stability, but there are important challenges in front of us, and probably the biggest one is also the most important, is the overall architecture of the European Union, European Euro area in special. What we are having at the moment, namely, is a common monetary policy, which is not confronted with a common fiscal policy. And here, I believe the main challenges lies before us. If we want to preserve this stability we are seeing at the moment, we have to make additional step in terms of fiscal policy, Now we are talking about the fiscal rules. Yes, it is a very important topic of utmost importance at the moment, but one must be aware that it is only a second best solution, and the first best would be to have a common fiscal policy, to have common tools to react to the shocks in a way we are able to react with the monetary policy.
Then maybe Boris. Oh, okay. I can give back to you the floor with a functioning mic. Okay, now it's working. Boris, your take.
Thank you. Thank you for inviting me to the conference. It's a pleasure to be here. And to start with, I have to agree with two previous speakers that, I mean, you cannot paint the picture too blue because we thought it's going to be much worse, both in 2020 and then in 2022. So it turned out much better than most of the people projected. So in that sense, the picture is actually much brighter than it was supposed to be according to the official forecasts of most professionals. So we did show a good resilience, which is a good news. Well, part of that, of course, is due to the ministers of finance and central bankers, ministers of finance, who went on to spend a lot of money to support the economy through both crises, and the central bankers who were willingly financed much of that. So this is a part of the reason why we were so resilient through these two crises. We do pay now probably partially a price for that, because there's no free lunch. So when you do a lot, at some point, the inflation rate goes up, as we are seeing now. It's partially a consequence of the rapid recovery after the COVID, much faster recovery of the demand than the supply was able to react. And then also because we created so much of the liquidity, there was so much of the fiscal support, of which some is still there, and probably at the moment with this rate of inflation should be removed as quickly as possible. Now looking at the medium-term challenges, I think we're living generally in a very different world now than we used to 10 or 15 years ago, and particularly before the GFC. To some extent, you can say that we have reaped the benefits of the globalization in a way that we saw super cycle of the very strong productivity growth in the emerging markets. So although the productivity growth was not so strong as Deborah said in Europe, or somewhat more in US, but again, not to the extent. You saw 30 years of a very strong productivity growth in emerging market countries. And we did not do much structural things in our country, in Europe, but the rest of the world did. Much better policies, a lot of structural things, and we were able to reap the benefits of that. But now looking at the world today and forward, it's now started to move in an opposite direction. So it's moving now in the direction of more fragmentation, and you see that in all fields. You see it in trade, you see it in the FDIs, you see it in the financial flows for different reasons, be it the protectionist trade measures, from tariffs to the export voluntary restrictions to the sanctions, etc., etc. So it's obvious that it has already, I mean, the data already are showing that the trade flows, financial flows, and FDI flows have started to change. Now, that creates, I think, a real challenge for Europe. Because we're going to be living in a different world. We won't be able probably to reap the benefits as we did before. So we will probably have to do more ourselves. in order to boost the productivity growth and the potential rate of growth, not being able to rely on things that we've seen before. When it comes to monetary policy, this new world that we're seeing shaping up because of the geopolitics means most probably significantly less elastic supply. And in a world of significantly less elastic supply, price volatility will be higher, which means that the natural interest rate is higher than it used to be before. So we're getting back to the world of higher interest rates. Although, we're not in a world that we have not seen before. Before the great financial crisis, we lived for decades in such a world of higher interest rates, so it's not such a novelty. You can say that it was more after the GFC, Eurozone debt crisis, and the Corona that we lived in a period of very low interest rates. And the good, more optimistic way to think about it is that we had a lot of investment growth at that time with a higher natural rate of interest. So why wouldn't we have it again in this new world? However, these geopolitical things will also affect us in a different ways. That the world looks different because we have much more competitors these days. You see how the different European industries are challenged, like the car industry with the EVs now from China, for example, and that calls for like a much more vigilance and proactive approach in order to stay at the frontier, or which Europe certainly can span the frontier. So we should think probably about structural policies to foster further innovation, because we do have a capacity for that. We can span the production possibilities frontier, and possibly we can do it in a ways that we have not been doing it so much up until now, where much of the innovation, for example, in Europe compared to the US, has been coming from the state-sponsored research institutions rather than from the private sector. So I think more private sector in Europe will have to be in the medium to long run a part of the response to the new world. And I'll stop here.
Thanks a lot. And I think all the points that you made actually are quite interesting when you start from the macro view and then go to the micro view. And today we are at the EIB, we are launching the results of a new study that we do every year. Is this, if you're interested, you can download it. It is our survey of 12,000 European firms and US firms, and they give us, we run it since 7 years, and it gives us a very good pulse on what is happening at the firm level in Europe. And what we see are a few elements that I would put as base for the future discussion. And I think very much gets the macro view that you were presenting. The first thing is that the European firms actually in the last year took the opportunity to transform, not all, but they tried. At least we have some good news in terms of advancement of digitalization. It may be the basic digitalization, or not the most advanced digitalization, but there is a use of digitalization spreading at the European level. Then another positive story is energy efficiency, energy saving. There was a push on investment in energy efficiency and energy saving. It's obvious, it was also very much related to high energy prices, so it's an investment that repays short term, but it's a good story. And the third point is that when firms were faced with trade disruption, they tried, at least up to now, to diversify the value chain. So it's not a complete deglobalization, but is trying to have a more resilient value chain. Then at the same time, and that's the good part of the story, at the same time we see that actually if you look at investment now, first of all, it's very different corporate investment across countries. but also because there are two main drivers. So it's relatively resilient overall at the European level, but based on the strong policy support, and that's where also part of the differentiation across countries comes, but also because the firms were able to build buffers and they are still using these buffers. But then on the other side, you see the tightening coming, the decelerating growth, and at the same time, you have a lot of challenges. On the innovation side, we see that European firms are innovating still much less. They are good in some niche innovation, like in green tech, but then they have the usual problem of the scaling up. And the additional point is that you know that these fast innovative countries in tightening cycles, they may risk more in terms of access to finance. So the challenge on this point of view remains. The other challenge is that it's true that it's a positive development on energy efficiency, but it's also true that it seems that the policy support that was very widespread didn't help the firms didn't give incentive to the firms more in danger to really transform. So we are talking about the most energy-intensive industry, those that really needed to transform. They are more on a wait-and-see attitude, waiting to see how it goes, and partly supported by the policy support of the last years. So the challenge ahead, I think, is that we all know that tightening conditions are coming. Policy support cannot stay at the level that we have seen on the fiscal side for sure. So the point is how to continue to support the transformation for the corporate sector, I'm thinking about it, with a policy support that is more targeted and really also incentivizing this reallocation of resources. Part of the support in the last year was really, let's keep all alive, but now it's the moment to say, no, you have to restructure, you have to transform. So the difficult part of the transformation has to start. We see it from the survey, but I wanted to ask to the panelists, what do you think about this picture? And also maybe linking it to the more targeted support. I think the more targeted will have to come because the fiscal space is not so open for the next years. And what do you think about this targeting of support, the fiscal space remaining, and the new fiscal framework? What all those bring for transformative investment, also from the public sector point of view. And Commissioner, I can start with you.
Well, thank you. I think what your research is describing, at least in my experience, is corresponding to what is happening. So indeed, we saw a lot of transformation going on in European businesses. Transformation incentivized also by public policies, national and Europeans, and transformation very much also oriented by the energy crisis. But energy crisis, differentiation of the supply chain at global level, trend of innovation, etc. So I think this is clear. What I think is needed, I would mention very briefly three things. First, of course, we need to make all the efforts to attract private investments in Europe. I think some of the decisions that we took, I'm referring, for example, to the green taxonomy, are going in this direction. We are taking several initiatives on what we call the Capital Markets Union, but they are important, each and every one, but of course we are lagging behind if we look to other global economic players. There is an enormous amount of potential private investments to attract. Second point would be, from my side, clarity on what we call the Green Deal, the green transition, etc. And clarity means, in my view, first, that Europe cannot abandon the role of first mover that we chose a few years ago. And this, because the advantage of the disadvantage of being late movers in this global transition for jobs, for technology, for competitiveness are too obvious to be described. But at the same time, of course, we need to deal with this green and climate transition with, first, pragmatism. We can't transform this in a sort of bureaucratic obsession. And second, we need consensus. Because if we don't have political and social consensus in this green transition, we will lose our role of first movers, and we will be affected by the consequences of being followers in this global race. So there is a balance here to keep: clarity in the strategies, clarity in the objectives, pragmatism in the implementation, and consensus, social, political consensus. My third and last point is we need to scale up our European public support to this transformation. And scale up this has several aspects. There's no time to address them. But of course, to put it very simply, we can't be only the queen of regulation, the European Union. We are very good in regulation, but we are starting to discuss industrial policies, which maybe 5 years ago was impossible at European level. But we should also start to discuss our common tools. I fully agree with what the governor said before, but I know how difficult it is to go in the perspective of a stronger common fiscal policy. But we should know that if we don't address also private investments, the green transition, but if we don't scale up also our public policy support to this transition, we will not be catching up with other global players because they are doing this.
Thank you very much, and I think it's a perfect switch, Bastian, to you to respond to that.
Yes, so my reading of the results you presented is that it's not necessary that financial conditions are the most important thing which is drawing back the investment activity and innovative activity. Namely, what is behind of us are almost 10 years of very low, even negative interest rates, with abundant liquidity provided by the ECB, and on top of that also some special instruments, we call them TLTRO, So special instruments incentivizing banks to lend and then receiving additional liquidity at even more favorable rates. So despite of all that, investments were still lagging behind our counterparts on the other side of Atlantic. So my reading is that more structural issues are behind these trends. And the first one was is something I already mentioned, and this is the strength of our union in terms how connected the markets are, how connected the financial markets are, how connected the banking system is. And this is definitely something which is not helping investment activity and innovation research activity. But there are also some factors on the side of our domestic national governments, more fundamental processes like overall business environment, a lot of red tape, problems with taxation. These are all well-known developments or facts which are not contributing to a better situation. Then there is a general attitude. The Commissioner was speaking about the political consensus, and my view on this is that it can be improved by very, very fundamental structural reforms, such as taking educational system, market, private initiative, and also labor markets. So adding all this together, we are in the situation when the companies are reporting on some deficiencies which are not necessarily related only to financing conditions.
Thank you very much. And Boris, maybe the point that so far was not touched too much is that is a reallocation of resources and the delay in transformation for the sector more at risk, but feel free also to talk about other things.
Yeah, well, I think that... No, you take yours. It's not only about targeted support, it's really about, I agree, about also deregulation and removing the red tape and making the business easier in Europe. I think that can go a long way, and in that sense, there is also a need for more common European policies and more common markets, particularly capital market. I think if you see what's going on now, you see a number of European companies moving to the US to list. So it's in a way, I think it's our failure because we did not create a capital market that is as competitive as the US is. And then you will simply see companies going there. In the beginning of the creation of the monetary union, the idea was, okay, you're going to have the common money market, you're going to have a common banking market, and in the end you will have common bond equity markets. People thought that there will be a single European stock exchange which will become very liquid with a good set of investors, competitive worldwide. Very little of that has happened. We have a common money market because it is, by definition, with a single monetary policy. But we have not been able to integrate neither the banking market nor the equity markets in a way that makes us attractive enough for the companies and for the financing. And if you look, for example, at particularly at the companies like the startups in the innovative technologies, I mean, their possibility of financing on continent is much lower than if they go to the Anglo-Saxon world, primarily to the US. These are the areas where we can definitely do without putting more money, but by creating the policies that will change the structure of the financial markets in Europe. And we have to take it seriously, because if we drag our feet for much longer, then we will see simply exodus of the best part of the European economy to other countries. And on the reallocation of resources, I think that you will see a massive reallocation of the resources going forward, among other things, because of the green energy solutions. And that, I think, again, there Europe has a good chance with good policies to basically leverage on a good basis for technology development that we have in Europe. We just have to be smart and do it in a way so that it does not move out of Europe again. So it's not like conceived in Europe, developed in the US, or things like that. So it's very much up to us to create a market in which the companies can not only develop technology but finance the expansion and scale up in a way that is competitive.
I would like to follow up with a question that is, so we are, I think we are talking about also the strategic autonomy and what should be done at the European level and industrial policies. And my question is always how to design an industrial policy that is European and national based, so really the European dimension of it in an open way in order to have an open industrial policy and strategic autonomy. And is it where we are going? Because a part of what we saw in the last couple of years was a lot of also national policy coming out. So how can we have an industrial policy really European and really based on the full potential of the single market? And maybe, Commissioner, I give the floor to you also because the Commissioner has to leave us in 7 minutes. So, yeah.
But I will not take the micro for 7 minutes. Well, first, it's so important that this question is on the table. It was not on the table some years ago. So the idea was, and it worked. I don't think we have to destroy the strength of this model. The idea was that a single market based on openness to trade, very strong openness, in some cases too openness, and based on competition internally, was sufficiently competitive. Now the tricky issue is that we can't lose this model. This is why we have this oxymoron, the open strategic autonomy. We can't lose this model, saying that, well, the European economy becomes a protectionist actor or an actor where state aid is free to flow in each and every country, increasing the differences within the single market. This is what we cannot do. So we have to preserve some of the pillars of the model, but at the same time, we can't ignore the fact that common support is key for industrial policies. What kind of common support for which policies? Well, this is not something that I can solve personally and in a few words, but I will make only 2 points. First, we should start, in my view, from the projects, the targets, the objectives of common European goods and purposes where there is a clear advantage in having a European scale, where the European dimension is needed and where the European scale is crucial. Second point that I would make is if we relate to common effort, common funding, common support, we shouldn't make the equation common funding, common support means redistribution, which was indeed the case with Next Generation EU. It was a tool to avoid differences, and it was a form of redistribution towards the countries more affected by the COVID crisis. But in theory, if you have a common goal, a common target, this could be of interest for Luxembourg and for Bulgaria. It's not something transferring from one part of Europe to another part of Europe. So this is not an answer to your question, of course, but is the starting point, in my view, to legitimate common efforts and to choose priorities where the European added value is evident.
Thank you very much. And I don't know if the two governors want to add to this point, or we switch to financial stability issues. What do you think do we have to worry going forward in terms of financial stability?
I think that in terms of the financial stability, if you believe our stress tests, we're doing fine. And the latest round of stress tests, I must tell you, was quite severe in a sense. You know, you do a stress test, then nothing happens. Then you do more severe assumptions, then nothing happens. So you do even more. So at the moment, it looks that the banking system is at least in a good shape. Whatever you do in terms of the assumptions, they still remain well capitalized and in most cases also quite profitable. In short run, of course, the banking sector is enjoying the benefits of the unconventional monetary policy going the other way in a way that it didn't shrink the balance sheet first and then raise the interest rates, but raise the interest rates with a large balance sheet. So now you get a very nice remuneration on safe assets that have been created by the central banks through the QE, while the funding costs have not increased much because the deposit rates stayed low, which are the main source of the funding costs of the banks. Now, over time, that will gradually change, so the funding costs will go up and the profits will shrink from these levels where they are at the moment. But banks will remain quite profitable for the period of time that we see ahead. On the other hand, on the other part of their asset side of their balance sheet, the loans, the most important one, we don't see much of the worsening there, in spite of the fact that the economy is stagnating. We're not in a recession, really. We're in, since the end of last year, in a kind of a stagnation. And the NPLs are not really increasing. The stage 2 loans went up a bit, but they went up somewhat before, then they came down, then they went up again for some companies. So again, it doesn't seem that much is happening there that should worry the banks in terms of the worsening on the asset side of the balance sheet, the write-offs that they would need to do. So again, I don't think that looking at the banking system as such, we're in a bad place. However, we know that there is a lot of non-banking financial institutions, and we know that these have been growing over time, and that there are linkages between the banking and non-banking financial institutions, and what lies there, in terms of the interconnectedness and maybe some exposures and leverages that we don't see might be something to be worried about if you would know what exactly it is.
Thank you very much, and thanks to Commissioner Gentiloni. And Bosnia, you may add that to the financial stability study.
Yes, in addition to what Boris just explained, and I agree basically in full with him, there are some additional reasons for the fact that we are enjoying good financial stability at the moment, and these are lessons learned from the past crisis. Namely, after the great financial crisis, we learned a lot about the supervision of the banking system, of the financial sector in general. We created new institutions. SSM was established, so now we have common rules for the supervision of the European banking system, more unified approach, including already mentioned stress tests. So many processes which help us to ensure that financial system is more stable at the moment. In addition to that, it's also true that we reacted to these past two crises from the policy perspective in a very different way as we did during the global financial crisis. Back then, if you remember, the austerity was the name of the game, or name of the response, but during this crisis, we provided enormous, unprecedented support to the economy from the fiscal side and from the monetary sides. And both these are reasons why we are more confident in the strength, soundness of the financial system at the moment. It's also true that what we are doing on the monetary side is very beneficial from the banks at the moment, at least in this initial phase of interest rate increases. Banks are benefiting because the transmission is not working evenly on both sides of the balance sheet, and this is one of the reasons why banks are very profitable right now in my country, in our countries, but all over in Europe in general. But looking into the future, I also agree that there are increasing risks in front of us, and that most probably the situation in the next year will be much more complicated as it was in the past few years.
I have another question related. Before we were talking about the new fiscal framework and the tightening condition. You also now were speaking about the fact that government reacted to the pandemic with strong stimulus. That means also level of debt are really high at the European level in some countries. And we still start seeing some pressure on spread, differentiation in spreads. Are you worried about some differentiation in spreads across countries? Do you think the situation is under control globally at European level? Boris?
Well, I don't see at the moment any worrying signs, unwarranted moves in the market that would need to make us worry about that. As you know, we have also created the TPI instrument of the ECB, and we lay down the conditions for activation of the TPI. And the main one would be to see something which is unwarranted by the fundamentals happening abruptly in the markets, but we're not at the moment seeing anything like that. Of course, TPI is not there to be discussed every week, but only when anything like that happens. I think that countries should be, of course, aware of the risks in the market, and they should be the first ones to do things that assure markets that the things will be under the control, both from the R&G side to make it, to say that way. And then I think if they do that, that's what is ideal situation. Then we don't have to do anything, because normally that's not something that we are there to do. But I would say that for the time being, what we're seeing are things which are warranted by the fundamentals and the levels of the yields that you see now on the government debt are, again, going back to what I was telling you before, in line with what we've seen before this episode of very low interest rate after the GFC Eurozone debt crisis and COVID. So these were quite, I would say, 15 years of atypical situation in the markets, and this is also very important for people to have in mind and project the policies based on realistic assumptions about what you can expect in the future in terms of the rates.
And in fact, this normalization, as Boris is pitching, may give a more kind of discipline to government to really start watching about deficit and debt. Do you think the normalization of spreads, if you want?
Yes, in general, not talking about what is going on in the markets at the moment, but in general, the movements of spreads are in a way a reminder to the governments that this coordination between fiscal and monetary policy is necessary not only because of the inflation part of the story, of the fact that in order to bring down inflation with the lower costs, we need coordination between monetary and fiscal policy. We need a proper response from the fiscal side, but also it's a reminder that fiscal discipline is needed in order to protect the spreads and thus help the central banks with normalization in other meaning of the word, and that is under the process of QT. Namely, without a proper response from the fiscal policy, without fiscal policy became oriented in a pro-cyclical manner as opposed to what it is now, it's of utmost importance to bring it in line with the cycle, with the requirement coming from the economy side.
And one should also say that this last couple of years were actually exactly that moment in time when the governments have the possibility to bring down the debt to GDP ratio because the surprise inflation effect. And we know that surprise inflation effect helps governments but doesn't last too long. So you could clearly see who have captured the moment to do it. I'm happy that my own government has managed to bring down the public debt to GDP by 16 percentage points in 2 years' time, and still we do more this year. And we know that inflation does not help in the medium to long run, but it does help in the short run, the public debt. And
no, that's. But another question, so we were talking before about the need to switch from the generalized fiscal policy support to more targeted policies. Do you see in your countries politicians being willing to go in that direction, and the tensions in terms of going to more targeted support, more restrictive fiscal policy? What do you see? Do you see it moving in the right way or slowly?
What I can observe in my country and in many other countries in my neighboring is this discrepancy between what the politicians are willing to do, are promising to do, and what is actually happening. And what is actually happening is that monetary policy changed the course completely. I mentioned before, just 1 year ago, we were in a negative territory with the interest rates. Now we are at the level of 4% in the euro area. And on the other hand, the fiscal policy is still being expansionary. And there are examples of not only my country, but some other big countries inside the euro area which are changing their plans, fiscal plans, and not for a better. So I think that at the moment there is a lot of discussion between us, a lot of understanding that the policy must be oriented towards the same goal, but the end result is still not such.
I think there is also a bit of a risk that when you do successively a lot in terms of the fiscal support, that people start to expect that this fiscal support will continue like that. And then whatever goes wrong, they come to the state and say, okay, so how are you going to help us? And it's not that you will always get these levels of the support, not nearly as what you saw over the last few years, because that is not just realistic, it's not consistent with the fiscal targets, and actually has never happened before. We just had also, again, a period of unusually expansionary monetary policy. So also I think it's very important for those on the receiving side to understand that this was unusual period and will not continue forever.
Yeah, but that's require a big shift that we still have to see in terms of practice. One thing that we see in the survey, and this is something I found quite interesting. If you look at innovative companies, really the ones that are at the top of innovation, innovating on things new to the world, so really the top of the innovation part, they are much more depending on subsidies. Also for the innovation, so they actually receive more support. But you already see that the share of those firms that are using subsidies is decreasing. So in fact, they will be penalized also through this point of view in terms of their future financing. And at the same time, what I was mentioning before, the fact that they expect in net term, they expect much deteriorated access to external finance, and we start seeing particularly on the scaling up of firms that venture capital, private equity funds in some areas are drying up. I would like to ask.
We do. Just to say that we do these kind of surveys in Croatia for many years, and for many years what companies are telling us is that the access to finance, and even in the latest one, is one of the least problems. And they tell us that the biggest problem, two biggest problems are lack of skilled labor and the over-regulation. And it constantly changing. So going back to what I was saying before, I think we can achieve more with that than with any kind of financial targeted support, simply to deregulate where companies believe that they are over-regulated, that the regulation is uncertain, where the risks which stem from the institutions, including the courts, are too high. These are the areas, I think, which are more important. Of course, the access to finance now with the tightening financial conditions, it's more expensive. But they still list it as not the most important problem that they face.
No, but I fully agree with you. Actually, that the top, the binding constraint are skills on the one side, and on the other side, the regulation. Boston, in the meantime, I would like people in the floor to start thinking at questions for the panelists. But Boston, you wanted to react on the innovation side?
No. I just explained at the beginning of this roundtable. Yes, it's not the financial conditions. I agree completely here with Boris. Firms are reporting that their main problems are different at the moment. Their binding constraints are especially labor market and not access to the finance. Access to the finance is actually at the very bottom of their responses. So we have to tackle this issue not through the financial system, but through the structural reforms, which are much needed, but also very hard to deliver.
I would like to see if there are questions. Okay.
Working? Yeah. Okay, we were just wondering what structural question we can ask to monetary policymakers, central bankers, and actually there is one thing which I think is interesting. We know that infrastructure spurs innovation and can create new business opportunities. The emergence of the mobile technology boosted the telecom sector significantly. Do you think that the introduction of central bank digital currency could be an infrastructure that can boost data generation and artificial intelligence in Europe?
Well, I don't think that it's a good question. I haven't thought of it in that way, never. But my first reaction would be the way I see the CBDCs is that they might not. If you're right, us as central bankers will be very happy, because then that means that the acceptance of the digital currency will be huge. Whether it will be remains to be seen. I think of it a little bit in terms of the strategic autonomy that was mentioned before, alternative payment system. But it will really depend how much of it is used on, and if I would be now a CEO of a telecom or fintech company, I would tell you, it's all about user experience. And because this is how things are now working, and everybody's trying to do something which provides a user experience that others are not. So we have the credit cards in our pockets. It works fine. You go there, you have it on your mobile phone as well, so you pay with it. And the question is then, what else can you do to make it more attractive for people to use it in the CBDC format rather than, because this is also digital money. This is not in a way, you can say it's important for the central banks to keep the control of the public money as opposed to the private money. But that's probably more an issue for China, and then the question is what's private, what's public there again. But there it took the form in which basically these means of payments provided by the private companies completely took over the market. In Europe, let's see how it works once we roll out the CBDC, but probably at this moment I would not expect that it would have such a big take-up that this happens.
You want? There was another question.
Yeah. Okay. Yeah. So here, one thing, one element that I find a bit missing in the discussion, not only in this panel but generally, is the in Europe is the issue of services. I mean, we spent a lot of time years ago discussing, the Union for Services, the Services Directive, the Bolkestein Directive, and so forth. And my experience as a consumer is that the situation is pretty disastrous, actually. So essentially the services are, 95% are national based. And there is not competitive pressure, it's all segmented. And this also prevents innovation as well. Because the incentive to innovate are small if your market is national, is captive. Think of, utilities, electricity, water, all the utilities you can think of, is, why be innovative anyway you have captive consumers? So my question is, why do you think this discussion is absent, and why, do you think it should be more upgraded in the current discussion? Perhaps it's more a question for Deborah but I would be curious to hear your views on it as well.
It's more a question for Paolo, but he left.
Yeah.
No, I agree. I fully agree with you. I think it's a discussion that has to come back at the table in a much more preponderant way. And I think there are two discussions that we always We always, the other one that we always name, but we don't analyze too much is the lack of skills. We always say in all conferences, in everything, skills. In our survey, it's lack of skills is the major impediment for firms' investment since 7 years. And almost all firms tell it throughout Europe. But I think it comes to what we really want from the European single market. And the European single market has the dimension of the European single market for services, but there are a lot of friction and limitation related to it, and it requires much more forceful tackling the limitations to the single market. So it's again the structural reform story. And I think on the skills issue, I think it's the other big topic that stays on the side, because it has to do with labor mobility within Europe. It has to do on education that is national based, national policies, national how do you say, definition. It's not a European public good. It's not considered to be a European public good, but with a free movement of labor, it becomes something to be considered also at the European level. So I fully agree with you that both topics needs to be back on top of the agenda. Labor and skills is, in the sense, it's even the year of skills for the European Union, but the capacity to go and really do something at the European level with the national autonomy in decision making is a challenge. I don't know if you wanted to discuss it on your side.
I might say something on the financial sector side, because it's more for Paolo, the rest, but obviously financials are services. Okay, so in that area, I think we did quite a bit to try to foster the competition. Primarily and the banking, as you know, is a very captive market. There's a much higher likelihood you're going to get divorced than you're going to change the bank. So it's a nice study about that. So what we did was, we for example, for payment services through the PS2, we allowed the non-banks to have an access to the accounts in the banks in order to foster competition, and it works. You do have a number of serious competitors in the payment services now in the European market. We're going further now, as we are now discussing the new legislation that will, directive that will allow also access not only to the bank data of the customers, but also the pension system, insurance, all institutions. So if you agree, you can share that data with anyone in Europe who is licensed to work in Europe to provide you any kind of services that they are providing, whether it be payment services, asset management services, kind of financial planning, etc. So that will also boost the competition. We talked, for example, on just before you asked the question, I was talking about one area where the payment services are not really national. There's credit card services that's provided by basically two institutions, of which neither is European, and it's provided on the whole European market. But you can do, much more competition, and we are working on doing that. When it comes to the traditional banking services, there we have to do more also, because that is a captive market, and the only real part of Europe where you have the bank penetration, intra-European bank penetration, is Central and East Europe. In West Europe you don't have it. So it's up to the West Europe to decide, okay, that no, we want competition, we don't want to have national champions, and let's create a level playing field for as I said before, for a banking market that is less fragmented than it is at the moment. But it's not only that, these are also risks, exposures of the banks. But because of that, you need more of the inter-European banking. For the rest of the service sector, that's Paolo is gone, so I want but you're right. Yeah, it's very difficult. And there is little, at least in the financial system, you have an effort to do something. I don't see much of it happening elsewhere.
Just a short remark. Now, while I agree with you completely that the progress here is very limited, and it's very much to do with governments, with the European Commission, but also the industry is sometimes lagging behind. And I can quote an example, and that is the real-time payment between the European banks. It is an initiative which is going on now for many years, maybe already a decade, and banks themselves are not able to agree on a common principles of common set of rules to make it operational. So it is partly connected to us, but not to have two one-sided debate. It's also the industry sometimes which is not able to deliver.
Is there any other question? If not, maybe we can have your final thought on challenge of competitiveness, European competitiveness. What optimism you see moving in the right direction or not?
I'm just going to say that I have always been a technology optimist. Now, how it's going to play out, I'm not sure, but many times before, people were worried that the next generation will not live as well as our did. And today we are again worried about that, but then it always turned out that every next generation lived better. So let's be optimists.
But
yeah, Deborah, during your explanation of the results between the firms, you mentioned that the progress is most often made under the stress, when there is an outside pressure and so on. So I can only express my hope that the next one will come sooner than the pressure from the outside will come.
And I think for some sector, what I remain struck on the result is if you look at the capacity of firms to transform, even on the because of the climate transition, you see that those that see an opportunity, that they declare that the climate and net zero transition is an opportunity, they are massively investing. So you have a positive stories that the firms are playing. But then you have a second part of the world, and those that consider it as a threat, and they are starting but slowly. And part of the concern is that at the end you have still a lot of support in trying to smooth the transformation, in trying to make it more affordable, which is it's absolutely necessary on a political point of view, but at a certain point you have to start this transformation. And I think the challenge that we will have in the next year is with really to make sure that the incentives are rightly designed for also the difficult part of the net zero transformation to start. And there are sectors, I think you both come from countries that had this transformation of the economy, maybe other countries more than the two of you, but
we have
Eastern Europe
70% of green energy in Croatia. So
yeah, no, but it's not, I'm thinking at the transition side. You have experience of a radical transformation in your economies in Central Eastern Europe, so that makes me positive at thinking that I think we will have difficult times on a political point of view in making the tough decision on the transformation of some sector of the economy, but I remain positive on the fact that we have a capacity to transform and we'll try to go there. I don't know, last word, both of you.
I agree with you. I mean, the transition shows that you can do efficient, massive allocation resources in a relatively short period of time, let's say 10 years, in a really massive way.
Yeah, let's remain positive that this will be the case.
So thank you very much. Great to have you in the panel, and I think we close the panel and go for lunch, I think.
Ladies and gentlemen, we will now break for lunch and invite you all